Thank you for putting up with last week's little technical difficulty. I hope you'll employ the sophisticated risk analysis tools available in Option Workbench. As I said before, Stan will try to answer the questions. And if your question is about Option Workbench, Stan may defer to me. I'll try to answer as many questions as possible during the question and answer period. First, I have to show this disclaimer. This is what the lawyers want me to do. So whatever I say here is purely for educational purposes, and I make no warranties about anything. So I'll give you a couple seconds to read that if you really want to. Probably nobody ever reads these things anyway. Okay, so far as the agenda tonight, we're going to just define a few terms that we'll be using during the demonstration. We'll go to a live demonstration of Option Workbench. Then we'll do a wrap-up and a question and answer period. So with that, I will proceed to the definitions. So what is risk analysis? Basically, risk analysis is the process of identifying risk factors and evaluating the effects of changes in the values of those risk factors on a position. This definition can be compared to risk management, which is really a process of monitoring the risk factors identified during risk analysis and making adjustments to a position. And adjustments could include closing the position if you think you're just losing too much money, changing the size of one of the legs of the position, for example, buying or selling the underlying to neutralize the position delta. So the next logical question really are, what are risk factors? So if you do a Google search, you'll find a lot of different definitions for the term risk factor. But for an option position, risk factors are really defined by the inputs to the Black-Scholes model. And the effects of these factors are indicated by the Greeks of the position. And the inputs are basically the underlying price, the effects of which are reflected in the values of the delta and the gamma, the volatility of the underlying price, which is measured by the gamma, the time remaining to expiration of the option position, which is quantified by theta. And in the examples, one of the examples that will be presented later, I might use the term near-term expiration when I'm talking about a calendar or a time spread. And this is because the method of risk analysis being considered here assumes that even if a trader's intention is to roll the near-term short option to another month at expiration, a new round of analysis is warranted to determine whether the new calendar spread is still a desirable trade. Finally, there's the risk-free rate of return, which is measured by the row of the position. Option Workbench uses the 90-day Treasury bill index as the risk-free rate, but that's something that you can also change in there. And the final input to the Black-Scholes model that's not included in this list is the strike price of the option. And it's not included because it doesn't change on the standard exchange-traded option. The next thing I want to talk about is expected value. And Stan did a really good presentation on expected value. And but what does that really have to do with risk analysis? Just to review, though, expected value is a statistical estimate of a value at some point in the future. A better name for expected value might be anticipated value, because the expectation is only really as good as the assumptions made in the calculation. In general, the expected value is calculated by multiplying each of a set of possible outcomes by the probability of that outcome occurring, and then summing all those values. The one that we use in Option Workbench, mostly there are two data points that are used as expected value calculation. The first is the expected profit, and this represents what the profit the position under analysis would realize on average if the position could be put on many, many, many times. This is not what the profit of the position will be this time. Most of the time, the position under analysis will realize more or less than the expected profit. The expected risk is the maximum expected loss on average, or the maximum expected catastrophic loss for this position. Excuse me. In Option Workbench, for a position with naked options, the expected risk is the expected margin that would need to be set aside for the position. The margin calculation is based on a formula that's used by at least 2 large retail brokers that I know of. And the details of the margin calculation can be found in the online help screen in Option Workbench. For those of you that have portfolio margin accounts, we anticipate having a portfolio margin calculation available in the near future. For a position with limited risk, like a vertical spread or a calendar spread, the expected risk can be less than the maximum loss of the spread. Usually, we'll see that it's a little bit less. Because of the nature of the expected value calculation, the expected risk of a limited risk spread will be slightly less than that. Option Workbench also presents 2 values derived from expected profit and expected risk. The expected return, which is just a ratio of expected profit divided by expected risk, and the annualized expected return, which is just that expected return annualized. So a fair question at this point is, so how does expected value relate to risk analysis? A typical use of expected value in options trading is the expected return just mentioned. This annualized expected return is really a good way to compare and contrast different positions, different strategies to each other or to acceptable market returns. It can be used to compare strategies on the same asset, on the same underlying asset, or on different underlying assets. Nobody really has infinite capital to spend. You have to compare and contrast assets on different strategies on different assets. And since the expected return calculation is based on a probability, it can provide a statistical edge to trading. So again, how does this all relate to risk analysis? The set of outcomes used by Option Workbench to compute the expected return of a given position is composed of several hundred possible values of the price of the underlying asset. The minimum and the maximum of this range are 3 standard deviations below and above the current market price, where the value of 1 standard deviation is determined by an assumption about volatility. Changing the volatility assumption changes the price range over which the expected return is calculated. And this technique can be used to test possible future outcomes of an options position based on changes in the price movement of the underlying asset. The probabilities used to weight each possible price are calculated using a log normal distribution. The log normal distribution is a generally accepted statistical representation of the price movements of tradable assets like shares of stock or future contracts. Another popular price distribution is called the fat tail distribution. And this distribution assigns slightly higher probabilities to extreme market moves. And we'll be adding the fat tail distribution methodology to Option Workbench at some point in the near future, but we don't really have an estimate available yet. Okay, so at this point, I will switch to the live demonstration and minimize this. Open Option Workbench. And I'm monitoring the broadcast here. Okay, so it looks like it came up. So what we're looking at here is I picked a couple of examples, and these are, admittedly, these are contrived examples just to show what can go wrong in a position. And I picked a calendar spread, as I indicated earlier, and a short put, because those are 2 fairly popular trades that a lot of people do. So this is a calendar spread on Apple. everybody's favorite stock the last few weeks anyway. And at first blush, this looks pretty good. This is the delta risk chart, and it shows what the theoretical P&L of the trade looks like. That's the blue line at different levels of the underlying price. Excuse me. And the roll up here that the cost of this trade was $11,850. That's in a 10 lot on that. And we have an expected profit of $9,671 and an expected risk of slightly less than the cost, as I said before. So again, at first blush, this looks pretty darn good. And we can see we have the delta risk. If we click here, we can see the vega risk. And going up to expiration, it looks like we have a pretty good shot of making money on this. Even if the volatility goes down by 50%, then we should be making money. And the theta risk, the time decay, works in our favor. But we've made some pretty optimistic assumptions in here so far. Right now, the implied volatility we can see up over here, the composite IV of Apple's in the 88th percentile. So it's pretty high, and you might not normally do this trade, but I picked this one just to show what the effects of changes in volatility will do to the expected value. So the key way to start doing the scenario analysis is to click the volatility shifts button. And this will bring up a window that shows us the historical volatility, and this is the theoretic for the expected value. We can see that in this table here. The 3 standard deviations down would be a price of $454.41, and 3 standard deviations up would be a price of $795.14. And the next row shows that on the expiration date, this is again our expected profit, risk, and return, and what the P&L would be, given our current volatility assumptions at each of these price levels. So again, that looks pretty good. But let's start playing around with it and see what happens. So I've picked a low historical volatility number. This is a calendar spread, so we want the price to stay about the same. But something could happen. There could be a supply disruption. Samsung could decide that they don't want to sell Apple the Retina displays anymore for the iPad 3. They want them for their own tablet, or they won't make the chips anymore that go in there. And that's going to introduce a lot of uncertainty. So we could say, what happens if the historical volatility goes up, to 30% annualized? What does that do to the expected value of this position? And if we click the apply button, we can see right away that this red line went down, not horribly, but it did reduce our expected profit by a couple of $1,000s. It was $9,000, and now we're down to just under $7,000. So that's taken a big bite out of it. But what also might happen when that uncertainty comes about, what also might happen is that the implied volatility of the options may go down also. That could be detrimental to this trade because it has such a high vega. You can see here that the overall position vega is 564. So that means for a 1-point change in the implied volatility of this spread, we can expect a change of $564 in the value of the position. And so if the volatility goes down by a point, then we expect to lose about $560 on the value of the position. We can look at that in a little bit more detail in this detail window, and you can see that the vega is pretty much dominated by the back month option, back month call on this spread. So let's see what would happen if the back month vega goes down a couple of points, or let's just move it down 1 point and keep an eye on our expected profit. You can see it here and up here. If I click the apply button, well, it went down about $600 to $5,771. But is that a realistic? Is that something that's realistic? It could go down. It has been down much further than that. In fact, we know since the IV percentile is high, it's around the 88th percentile, that it's relatively high at this time. We can take a look at the volatility study and see where it's been recently. So we can see, well, it's been hovering around this 30 level for a little while. It jumped up recently. It looks like it's coming back down. It's been as low as 20. And then, it's been between 20 and 30 for the last little while. We can go back a little bit further and take a look and see that, well, it's really been, this is pretty high, as testified by the implied volatility percentile. So let's see what happens if we lower the volatility by a little bit more than we were looking at before. So what if this back leg goes down to about 25.5, and we can lower the front month also. That will help in the interim, but it won't really have that much effect on the at the expiration date. If I click the apply button again, well, now our expected return is going down, quite a bit more. And additionally, what that's doing is that's squeezing in the break-even points. So we can see that, our downside break-even is down here around 550, 554, 553, and the upside break-even is up here, about 654, 654 and change. So the whole curve has been shifting down. What's also interesting to look at is how does this affect us moving up to the expiration? So I picked the May-August calendar spread, and so let's see what happens. At the end of April, how does it look? Well, we have a much lower expected profit at the end of April, and then going into May, leading up to the expiration. It's not really until the very end that we start seeing the real appreciation there, and we haven't really stressed the position very much either. If we go back to the volatility study, you can see that it has been down, not too recently, around 20. So we can stress this position a little bit more, and we'll do a Fed stress test and put that back month down to about 20.5, and we'll help ourselves out by assuming that the front month is going to go down too, that the whole surface is going to shift down. And this time I'll click the close button. Now we see that we've really got a problem here. So our expected profit went negative. So now instead of that nice $9,000 85% return, we're looking at a negative 24% return. Now, none of this is to say that this is what's going to happen, but it's something that you have to be concerned about. Even if we assume that the historical volatility isn't going to change at all, we can assume that it's going to stay the same, even if it settles down. That's still not going to help us very much. That raises our expected value a little bit, but not enough really to overcome the decline in the implied volatility. And all this can also be demonstrated on the Vega risk chart. So now, under these volatility assumptions, we see we need the volatility to come back up quite a bit in order for us to start to break even here. And even the time decay is really adversely affected. So now, we need to wait almost 28 days to start breaking even on the time decay. So these are just some things that you need to be careful of when you're going into a position. Now, admittedly, this is not a good time to be buying volatility on Apple because the implied volatility is so high. So you might want to look at something else. But again, I picked this just to to demonstrate the point and on how to use these tools. Another really useful tool is the risk report. If I click on here, it opens up a browser window with this report on it, and the report shows what spread you did, what the price of the underlying is, your trade date, the details of the trade, and the 3 charts. Another chart that we'll be adding soon is the row chart. Interest rates are so low right now. There's not really, unless you expect a huge spike in the interest rates. There's not going to be that much. Okay, here's an interesting question here. Why does let's see, isn't the IV minus 43? Oh, okay. Now that's not the implied volatility, or this minus 42 is the implied volatility factor of this trade, which is the percentage discount or premium to the composite IV. It's a 43. This must be a little bit of rounding error. So you can see that the implied volatility of this trade is 20.74, and the composite IV of all options is 36. So this trade is cheap compared to other options, but these are for informational purposes about the trade that you did. So it's not; these don't change when you change the assumptions about the scenario during the scenario analysis. And let's go back to the risk report for a second. And then on the bottom you can see what the assumptions were that you made and the theoretical P&L table there. Okay, so now let's switch to another trade where if the volatility goes up, you can have a problem. Now again, this is a contrived example. I picked something, National Oil Well, where the IV percentile is low, and now this IV factor is 46. That means that this, you're selling this put for 40.55 vol, and the composite IV is 27.8. So you're selling expensive vol, but overall these options are really cheap. So what would happen to this trade if if we do the same kind of volatility shift? So let's look at the Vega risk. Right now, since there are no back month options, this line is flat because it doesn't matter what the volatility is on the expiration date. You get your $980 on this 10 lot. Sell it for 98 cents, and then the time decay looks really nice. It starts at 0, and we make money as time goes on. But again, what's going to happen if volatility starts moving up? If there's Iran blocks the Strait of Hormuz, or National Oil Well, I think they're involved in Brazil, and there's some shady stuff going on in Brazil. There are some oil leaks or something like that. So again, I picked a low volatility here, but let's say if it goes up to what the 100-day historical volatility is, well, that brings our trade down. It had a nice, I forgot what it, what's going on here? I'm trying to reset. Oh, sorry. It had a nice 5.8% return, 35% annualized. Well, that looks really good, but if the historical volatility increases, that brings our nice 5% return down to a 1% return. And so far, it hasn't affected the expected risk. But if there's a lot of uncertainty and this volatility goes up, it's not unreasonable for the implied volatility to go up about 10 points. So I can click that, and now we still have this low expected return. But the question with this one is how long are you really going to want to stay in this position? Because even as the time goes on, your margin requirements are going to change. So if we just wait till the end of the month, well, you can see that at the end of the month you have a negative expected profit, and you have somewhat increased margin requirements. And even though we'll just put a couple more dates in here as we get closer to expiration, you can see that the margin requirement's going up until about the week before expiration, and then it starts to go down. And then we can again look at our Vega and theta risk charts. You can see the time decay. It's going to take us about 20 days to move to the break-even point on the time decay, and we really haven't stressed this position much. In a stressful situation, it wouldn't be unusual for the volatility, the implied volatility, to go up 20 points. That doesn't make it a really expensive option, and we're starting to add a few $100s to the margin requirements. And especially if there's a big price drop or a big move in the price, we can stress the historical volatility a little more, and try to see where our downside break even is, and play with different scenarios here, and figure out what are we trying to risk, or how much can we lose on this. It's not really about, you already know how much you can make on this. It's $980. That's the most you can make. But how much can you lose, and what's the probability of making that, of actually losing that much money? So that's about all I had for doing these risk analysis, these scenario analyses. Let me switch back to the presentation. Now, as a special for attending the webinar, we have a buy 1 month and get one free. Basically, you pay the discounted 1 month subscription rate, and you get 1 month free, and that gives you 2 months at $60 to try it out and explore the searching and sorting features and the strategy comparison features. As far as upcoming new features, we're looking at getting an equity data package, so that we'll have earnings announcements and dividends in there automatically, and you'll be able to mark them on the volatility chart and click on it and be able to look at the what the volatility surface looked like around around those earnings announcements. There's also the Macmillan Analysis Mentoring Program, and again, Stan Freifeld is the head of that. And if you are interested in the mentoring, you can contact him at stan@optionstrategist.com. And we also have a LinkedIn Option Workbench discussion group. So if you want, you can, if you're on LinkedIn, you can search for the discussion group, and you just click the request for membership, and we'll get you in there. We talk about Option Workbench features on there mostly. Here's the contact information. If you have any questions for me, you can get me at support@hilcosoftware.com, or visit the website www.optionworkbench.com. If you have any questions about the Option Strategist, you can contact info@optionstrategist.com, or visit the Option Workbench page on the Option Strategist. Okay, so at this point, I'll take some questions if there are any. I might have gone through this a little quickly, so if there are any questions, please let me know. Okay, guess there are no questions. Well, here's a LinkedIn dropped on February 20th. How to trade it? Well, I really can't talk about particular trading strategies. I'm not really a registered investment advisor, so and I'm not familiar with LinkedIn anyway. Are there any data feed subscriptions required? Well, the Option Workbench subscription comes with a subscription to the Strategy Zone, so that's really the only data feed subscription. The equity data, the new equity data feature that I talked about, there'll probably be an additional charge. So we're not sure what that is right now. Okay, someone asked, could I demo the sorting feature? What I can do is I will show you what I did actually to find these, to find the ones that I'm looking at now. So for the for the naked put, this is the, oops, don't want Apple there. Okay. So for the naked put example, I used this filter, and I was looking for options. I mean, this is not really how you would look for something to trade. Let's see. But basically, this is the filtering. In this case, I was looking for naked puts that I wouldn't really do. So I looked for low volatility below the 32nd percentile, high volume, askew, price between 25 and 150, and composite IV that was less than the 50-day historical volatility. Let's see. Is there a manual or tutorial? There's an online help that shows you how these filter criteria work. So if you click on filtering and sorting, here's a description of the filter formula. I'll be putting together an online tutorial, and I'll be posting that online, like a YouTube video that goes into details about the filtering formula and the sorting. So here's this describes the filter formula, and then for the sorting, you click on a column header, and so now this sorted by IV percentile ascending. Okay. Question. Okay. Robert asked, how does he find out his username and password? Robert, I'll send you an email with your username and password. Someone asked what features does Option Workbench have that TOS, I guess, Thinkorswim doesn't have. Really the main thing is being able to do this searching and sorting on the option profiles. I guess I'll describe what these are for a minute. This is data that's on the strategy zone, taken from all the different reports on the strategy zone that measure implied volatility, historical volatility, and option volume. And you can see here, this filter that I used, there are 3,515 stocks with options that are covered on the strategy zone, and we filtered those down to 28, by using these filter criteria. And there are also, on the strategy zone, analyses of calendar spreads, covered calls, naked puts, and straddle buys, and you can use the filtering criteria in those also. And I've got a whole bunch of these criteria that I use. I don't really want to get too far into that right now because I can go on for an hour and a half about that. Okay, the fat tail distribution, it's coming. I'm not sure exactly when it's going to be there. The earnings package, let's see, ready for upcoming earnings season. No, we probably won't have it for this quarter. Probably for next quarter, for the fall quarter, we'll have the earnings package. Might be a little bit earlier than that, but I'm not sure yet. I mean, I guess that would be a popular thing. So we'll try to get that going as soon as possible. Let's see, what else can I answer here? Okay, Steve asked if these are canned criteria. No, they're not. You can type in anything you want here. So this is calendar spreads. I can just start typing in the criteria, and I'll use this AND function. So I'll say, typically I'll want, short IV to be a premium over long IV by at least 10%. So I'll say greater than 1.1 for that division. Okay, so now I've cut out almost half of these. I went from 2007-09 to 1653. There are lots of other criteria. I want liquidity, so I'll say I want total volume to be greater than or equal to at least 2,500 contracts. And I got rid of a few more. I want the short days to be less than 45, and I want long days to be less than about 140. So that's about 4 months, 5 months. So now, as I type these filters in, it keeps reducing the number that I see here. So these are dynamic. These are dynamic filters, and it remembers the filters as I type them in. So if I click down here, I can see these are the ones that I've been typing in. Another future upgrade is we're going to upgrade this, how it remembers these, and you'll also probably be able to give them names. I'm a little bit not sure about that because these things change a lot given market conditions. The way the market is now is not necessarily the way I'd want to look for calendar spreads the way it was last fall, if I was going to do calendar spreads at all last fall, because excuse me, options were so expensive at that time. So they're really dynamic spreads. Okay. Okay, is there a spread profiles for vertical or iron condor spread? No, the only spread profiles on the strategy zone are the 4 that are here. You can definitely set one up manually. I'll just I'll pick a stock. I'll go back to Apple just for the heck of it. So if you want to set up a vertical spread, let's say we just want to sell a put vertical. You can sell this bull put spread. Let's do it for March. We'll sell something that's out of the money, the 580, and buy 570. I have no idea how this is going to work out, but this is how you would set it up. Well, and maybe that's not so bad. We have to see what happens with volatility, though. So that's how you set one up. For an iron condor, there are a lot of these spread builder menus. I don't have one for an iron condor yet, but you can pick the custom menu, and then you can build it a little bit at a time. So, well, for an iron condor, we'll sell that same put spread. What did I do? 580, 570. Town lot, and then sell sell the bear call spread, 620 since we went $20, 630 for expiration. Add that in there, and there's your iron condor. Oh, you can change the name of it too. Say this is the Apple call it iron condor. So you have something to look at it, and this is how you would compare and contrast different spreads. You can sort on here too. Normally, I would sort descending by annualized expected return. So far, it looks like this bull put spread is the spread I would want to go with. But there's a lot more that you need to do to really decide which is the best thing to do at this point. So there are a lot of different ways that you can set things up. And even these two, they look pretty good, but their IV factor is low. We're selling cheap volatility on those. Robert asked, does it handle weeklies? Yes, definitely handles weeklies. In fact, the first, the bull put spread that was on there, the first expiration is that weekly. Apple has weeklies, so I can put in the 580, 570. Oops. See what that looks like. So I mean that has the best IV factor and expected return. But we haven't changed any of our assumptions yet. So I don't know what that what that will look like. And okay. Any more questions? Okay. I guess that's about wraps it up then. Thank you all for coming. And again, if you have any questions, my email is support@Hilco and I'll be happy to answer. I really like talking about this stuff, and I hope to see you soon for the next webinar. Have a great week.
The organizer has ended the session.